Well, AIS first wants to extend its appreciation and thanks to AIER for helping organize the marketing and the organization of this presentation. We have 4 speakers today, and each of them will talk to you about a different way of holding an exposure to gold. In this world of investing or hedging, there are active approaches, there are passive approaches, there's the owning of gold or surrogates for gold, there are ETFs, there are mining companies, and each deals with a different aspect of the economics of trying to achieve a store of value. So that's what you're going to hear from 4 experts. I will talk as well, but more on the question of why you should own gold. And I'm going to look at a very unusual slice of history that normally is totally ignored. And that's what happens during deflation. I want to just say a few comments about each of the speakers up front. Then I'll go into my presentation, and then each will follow each other in turn. We hope to give them about 25 minutes and leave the questions to the end. I know for some of you that may be difficult. Take notes, but if the urge is so overpowering that you have to ask a question for clarification, please do. We want to encourage you to ask questions, not give speeches. You know, some conferences, there are folks who've got agendas and they think they should take over through the Q&A period. Please don't do that here. Of course, there's the final disclaimers. These are all opinions of the individual speakers. Nothing you hear today should be taken as personal investment advice. That's obviously a more complicated issue because everybody has a different situation. But we'd welcome talking to you about that too, because the president of the investment management arm of AIER, John Barry, will be the last speaker. So the first presenter is James Turk, very well known, director of GoldMoney Foundation, and he will emphasize the physical holding of gold. He is widely known as one of the foremost advocates of owning gold, and also highly innovative in that he has created an instrument or a means of owning gold through what's called digital gold. But he has facilitated gold ownership to investors all over the world and has a very interesting story. The speaker after him, Robert Miller, is the managing director of Miller Mathis, and he will emphasize ownership through mining stocks. His particular field of expertise, his prominence, is as a financial advisory and restructuring expert in the metals and the mining industry. The fourth speaker, David Nadig, David Nadig, is head of research at Index Publications. Now, you're all aware of ETFs, and they come in every imaginable flavor. Some of them are actively managed, some are just index related, and there are very few reliable sources of information about what is the nature and attributes of these indexes. That's his job. But today he will talk in particular about the ETFs that give you exposure to gold either in the bullion form or in the securities form, equities. And the last speaker is John Barry, the president and CEO of American Investment Services. And he will talk about the role of gold investing as a component of an overall passive investment strategy. I will leave it to him to explain what that means. But that's something that is the specialty of AIER's investment management firm. We did have another speaker who expresses regrets, and that's William Mulligan. He did appear in some of the earlier announcements, so if you expected to see him, I'm sorry, you just couldn't make it. So let's get into the charts that we will both put up in front of you, as well as are available to you, I believe, in handout form. Normally, gold is looked at as a hedge against inflation and a store of value, or something to hold in difficult times of political turmoil, war. What isn't often thought about is what happens to gold during periods of deflation. Is it a sound investment then? Does it protect your purchasing power? And there's a big problem in trying to answer that question because there are problems of definition, like what do we mean by deflation? So the question I want to answer today is what happens to gold during deflationary events? Now, the relevance of this question isn't just some theoretical issue, but if you're paying attention to the divisions of opinion amongst economists and market pundits, you will note that there are those who believe that the Fed has set the groundwork for a massive inflation down the road, which may or may not occur depending on what policies they adopt when inflation begins to heat up, which of course would mean would delay withdrawal liquidity and money supply. But the alternate scenario, which is a little more troublesome and frightening to all of us, is the possibility that we're going to enter into yet another slump, both in the United States and in Europe, and we may have another recession, and the Great Recession will become a greater recession. And as has been noticed, that tends to bring about some kind of a deflationary experience, certainly at the commodity level, less so at the wholesale and producer price level, and even less so at the consumer price level. Nonetheless, deflation is a possible scenario, and the question then becomes highly relevant: what happens to gold during deflations? A deflationary event I'm taking to mean a negative rate of inflation that exceeds one standard deviation in the distribution of annual volatility. That sounds complicated, but just accept that gold is volatile anyway, independently of whether or not there's inflation or deflation. And in order to say something is happening, it has to be significant. So we take significance to mean that it's something that occurs outside of the normal 1 plus or minus 1 standard deviation, which is roughly 2/3 of most of the activity at pluses and minus moves in gold. It has to be more than a 2/3 probability event. Now, annual data is all we have for deep history. There are, of course, monthly data in the United States, the CPI, Consumer Price Index, inflation. But when you start going back in time, forget it. Governments really weren't there to publish statistics, and it's a mess. Nonetheless, several economists and historians have done a pretty good job. One was a fellow named Dr. Roy Jastrom, who wrote a book called The Golden Constant, who actually gathered all known extant data in Europe from various gold trading houses and so forth, and assembled and patched together various indices of inflation. And then, as part of an exercise, I think for the bicentennial, the Department of Commerce put together this massive 500-page, 2-volume book on historical statistics back to the colonial era for the United States. And in that volume, they have annual numbers. And of course, gold prices you can get from a variety of sources. So that's the hard work, gathering all this stuff and then trying to assemble it into tables and charts so that you can discern some patterns. I just want to make one more comment. I mean, what is inflation? Today in the modern times, consumer prices are 2/3 labor costs and only 1/3 raw materials, finished, semi-finished goods. And that wasn't the case back in the 1500s or the 1600s, 1700s. Most of the people would buy raw materials and then make things in their home. They'd make their own apple pie. They'd make their own clothes, just to use a few obvious examples. So it is appropriate to use commodity or wholesale prices. The further back in history you go, it's more questionable whether that's the right way to do things today, but we don't have a lot of choices. So let's look at charts 1 and 2. If we could move, or do I have a clicker? Thank you. So this is taken from the Jastrom book. I've tried to clip off all unnecessary information. This is not intended to be an academic publication. Obviously, there's need for some attributions here. But anyway, this goes back to 1560. The red line is the measure of inflation. Wholesale commodity prices is how he labeled his data, and he indexed it to 1930 equals 100. And the green line is gold. And one of the things that's very apparent is that it appears that there was very little activity in gold prices for several hundred years until we get into the turn of the century, into the 20th century, and then things all seem to take off. Well, part of the problem is optical because the scales need to be expanded to see more cycles in the earlier centuries. But that is the broad sweep, relative stability. And by the way, was gold freely traded in 1570? Was there a central bank where you could go and exchange whatever coins or currency you had in your pocket? I mean, it's a very complicated topic. But there were trading houses in the UK in particular. I think it was called Makata Goldschmidt. That was a well-known, established, long records and foolscap paper that they kept the transaction prices on gold, and that's where this came from. The second chart is the U.S. experience since 1792, and there again you see a long seeming period of stability, but there's a little more cyclicality. But as you know, gold was relatively fixed in price for most of that time. But I've marked off with those vertical lines the taller of the two being the peak in inflation and the lower of the two vertical lines the trough. And these will be the episodes that I extract and then eventually put into the table at the end. And I'll summarize what those numbers are, but I just want you to understand the chart that you're looking at. Gold in UK and US over the overlapping period look very similar, but they are for most of the time, but you'll notice in the 20th century, gold prices outstripped the movement upward to the US, and that's largely because they had much more inflation. And all of this is measured in local currency terms. And you can see that in the lower chart where the blue line is the inflation index for the UK versus the US. So one last point to help you understand, when you talk about deflation and you talk about what happens to the price of gold, when you're using annual data, it's obvious that you can miss a lot of information. They say like drowning in a riverbed that's only an average depth of 6 inches, but in fact there are potholes that are 12 feet deep. You miss a lot of information when you look at annual data versus. So I've actually given a second set of calculations just to see if there's any distortions. And this is the summation. So at the bottom, well, the left-hand side are all of the deflationary events in the United States. The first column is the end year, and it was the first event. I'm just going to help you so that you can read this more carefully later, but at least know how to read it. The first one is the end year, 1798. As you look across, you see that inflation dropped by 11.7%. Gold was unchanged. It was not freely traded. And this led to a gain in purchasing power for the owner, the holder of gold, of 13.3%. And it was a 2-year event. And you can go all the way down. And if you look in summary, you see that on average, these episodes of deflation, which lasted an average of 5 years, produced a deflation of 22.5%, we call 23 round numbers. On average, gold decreased during these periods. Sometimes it didn't decrease at all, sometimes it was rather sharp, as you see in the 1998 period. And I think that's worth pointing out and stressing. There's no guarantee gold goes up in value over time, although on average it does, and it goes up by more than inflation on average over time. But during deflation, the message here, at least in the US experience, is that it's still a store of value because it doesn't go down as much as the general price level. So you're actually coming out net ahead, and the number is 31% increase in purchasing power when averaging all of these events together. So that makes a strong case. In the UK, and here we're going back much further, amazingly enough, you have very similar numbers. The average deflation was almost 7 years in duration. The prices fell by 22%. Gold, on average, fell a tiny bit, 0.6%, and there was a net gain in purchasing power of 36%. So I think that's all we need to establish here for purposes of whetting your appetite, that there are good reasons to be an investor and an owner of gold in good times and in bad. If you had a crystal ball and you knew exactly what was going to happen, you could probably strip out those events where nothing is happening on the inflationary front. Because there it's not clear that owning gold or not owning gold gives you an edge. But we do know that when there's inflation, and that will be part of another paper, you have a protection. When there's deflation, you have protection. And I think that's what matters most. So with that, I want to turn over to the presentations to James Turk.